David?
Muted, my mistake. Hi, I'm David Mandy, president of O&M Partners. I want to welcome everyone today to the Pure Gold Mining Town Hall live webinar. Pure Gold trades on the OTC. They have a U.S. listing under the symbol LRTNF, and on the TSX Venture under the symbol PGM. For those that are new to our broadcast, O&M, we position ourselves and think of ourselves as the kind of the link between the investing public and public companies. In past times, these groups have kind of passed each other like ships in the night. But our digital roadmap has really helped us keep up with the tremendous changes of investor demographics, even before COVID, and now even more dislocation. So this call allows us to bring a large, disparate group together. We want this broadcast to answer all your questions. Questions can be easily answered by going to the question portal of GoToWebinar, or you can email us. For any questions that remain unanswered, be assured we'll follow up in a timely manner after the call. For those who dialed in by phone, the only way you can hear our pre-recorded introductory presentation is on your computer speakers. If that's not possible, you'll be able to hear the main presentation after 11 minutes, so we hope you'll please stay tuned. Before we turn to our hosts, I'd like to introduce our introductory speaker named Brian Lenny. Brian is with the Junior Stock Review. He's a founder of it, of the website, and offers information, ideas, strategies for managing investing in the resource sector. He adds a special level of gravitas, being trained as a professional engineer by trade, over 10 years experience in the heavy industry. So on that note, it's a pleasure to turn the call over to Brian Lenny.
Thanks for the introduction. Today I'm going to be giving a presentation on gold. Gold in 2020, global pandemic, soaring debt, and the threat of war. Gold is money, and I also believe it's the insurance that everybody needs to have given the financial and social calamity that we're seeing today. Today I'm going to talk about why gold is trading at an all-time high and why I think it's set to go much further, and how to profit. So gold is trading above $1,900 an ounce, and there's two reasons why. First is the COVID-19 pandemic, and second is the social unrest and the potential for war. So first, starting with the COVID-19 pandemic, really, I believe this is the straw that broke the camel's back. The lockdown in March, shut down the global economy, an unprecedented step. People lost jobs around the world. Sectors, it looks like they might even be destroyed. Restaurants may never be the same. We really don't know the full consequences of this, unprecedented step. In response to this, to these moves, interest rates have been cut back down to 0%. And taking the U.S. as an example, Jerome Powell, the Federal Reserve Chair, said we should see 0% interest rates for the next couple of years. So basically, for the foreseeable future, we're going to be at ultra low interest rates. Further, it may be even easier for all of us to get our heads around are the massive amounts of stimulus that have been pledged around the world. We use the U.S. as an example. The Fed pledged, 1.5 trillion in expansion of repo operations. In an unprecedented step, they entered the corporate bond market. This has never happened before, and really not really sure about how this is going to work out. They've launched the money market mutual fund liquidity facility, and that's around 10 billion. And then of course there's the CARES Act, and that's around 2.3 trillion. And that breaks down, $1,200 per person, $500 per child, additional $600 per week for the unemployed, 500 billion for businesses affected by the virus. The list keeps on going, and there's a ton of money that's been put into the economy. And so debt is soaring around the world, and it's not just the US. The Eurozone, I believe it was just over a week ago, pledged 2 trillion in COVID economic relief. And of course, a couple weeks ago, Canada came out with a projected deficit of 343 billion in 2021. And on a per capita or per GDP basis, this is a huge amount for Canadians. And really, there's no end to this spending in sight. And I think this is something we're going to see continue as governments are becoming a larger part of the global economy, And really, this isn't a good thing. So now we go to the second point, and this is social unrest and the potential for war. And talking about social unrest, and really what I think is at the core for the social unrest is the wealth gap. And in my view, the wealth gap between rich and poor is directly related to that last slide. It's basically all those, quantitative easing, low interest rates, everything that has been, brought into fruition with the governments to ease supposedly our daily lives only adds, to a devaluing of the dollar and ultimately these crashes that we see. And really, it's only the rich that can benefit fully from these crashes and buy assets when they're cheap. Businesses, real estate, the stock market. They're able to deploy cash they have on hand, or they're able to take out loans from banks to take advantage of it. While the middle class and poor really either don't have the willingness or the ability to buy things when they're cheap. And therefore, this wealth gap continues to grow. And unfortunately, I see this only continuing in the future. Another big point, the US election on the horizon, the political ideologies between left and right have never been more polarized in my view. And the problem with this is no matter who wins in the election this fall, 50% of the population is going to be upset. And I think when you coincide this with the wealth gap growing, I think protests, riots, violence, are a thing probably that's going to follow us for the next little while until we get a handle on what's going on here. Now we move on to the potential of war, and we actually might be at modern warfare right now, and it would be a financial one. And of course, the opponent, so to speak, would be China. There's a lot of different things going on financially with China right now. You see the tit for tat orders for closures for embassies in both countries. There's a really big potential catalyst or conflict growing in the South China Sea. The US has openly said that they don't recognize China's claim on a portion of the islands, and this could be a big contested item moving forward. And then finally, you have the financial sanctions that were brought by the US on China over the human rights violations. And it's not just the US, there's a few other countries that have joined the party to inflict financial sanctions on China, given what's going on in the country. And the Chinese, the different spokespeople have said that there will be a retaliation to some degree, and it should be interesting for the coming weeks and months what this ends up being. Unfortunately, I think there's a strong parallel if you look to the 1929 crash, of course, the Depression era over the 30s, and then the lead up to World War II. It's eerily similar, and I hope and pray that we're not headed this way, but it looks like it could be a possibility. So in saying that, I think the price of gold is only going to go higher. You look at the 10-year chart here. The last time we were at this level was 2011. Of course, today, we're trading above the all-time high, above 1920, and really, I think gold is going much higher. Unfortunately, like the late Richard Russell says, in the next crisis, it isn't who makes the most, but loses the least. And I think these are very wise words. As a high gold price is good for resource sector investors and holders of gold. But the flip side is gold really is a barometer of the global financial system. And clearly, gold is telling us that something's wrong. So how do you profit? In my view, it's speculation within the junior companies, and it's in two main types of companies: exploration and M&A candidates. Before getting into those specifically, let's take a look at the VanEck ETF GDXJ, and I want you to get a picture of how undervalued the sector on a whole is right now. You go back to 2011 when the old high was at 1920, and you can see the GDXJ was valued over $150. Fast forward to today, gold is trading above 1920, and the GDXJ is just over $50. Clearly, there is room to move up. The sector is undervalued. So the first type of company that I like to talk about is exploration. When it comes down to it, in my view, the market is hungry for discovery. If you look over the last couple of weeks, months, the market has been paying companies that have come out with great drill results. And I think this will continue in the future, especially as the gold and silver prices begin to go further or higher. Remember, the caveat with exploration is that it absolutely comes with the highest amount of risk. The fact is, most companies will be unsuccessful in getting that good drill hole. So investors need to balance that risk to reward. And you need to pick the right people that have the right projects and the cash to execute to make those discoveries. Second are the M&A candidates, and this covers both developmental and producing companies. Developmental are companies that have deposits and they're working towards expanding these and getting economic studies so they can lead to being a producer. And then of course, a producing company is a producing company. I think there'll be three main criteria that senior mining companies will be looking at for their top mergers and acquisition candidates. And I think it begins first with first quartile economics. While the last cycle was characterized by senior companies adding marginal ounces in the ground that were super cheap, but made their balance sheets look great, and really didn't work out that well. I think this cycle is going to be more characterized, at least in the beginning, with companies going for quality over quantity, at least in the beginning. Low all-in sustaining cash costs protect the downside risk of the senior companies over the mine life. And you know, these mine lives are over 10 years, typically. And you want to protect that downside risk because you don't know where the metal price is headed over a decade. Second to that, I think size matters. For senior companies, they want to make an impact to their bottom line. And therefore, I think they're going to be targeting deposits or projects that have over at least 2.5 million ounces in total resources. Second to that, I think they want to see a minimum of 100,000 ounces of possible or potential gold production in a year. And then tertiary is a large land package. The senior companies want to be able to potentially expand their existing deposit and possibly find other deposits within their property. The second point is jurisdiction. I believe tier 1 jurisdictions will be the focus of the senior companies. Second and third tier jurisdictions, while there might be some intriguing projects, I think the uncertainty that is flowing throughout the world will focus senior companies on the best jurisdictions, Canada, the United States, Australia, Japan, and parts of Europe. And finally, even though we live in a society of low interest rates, essentially free money, I believe low upfront capital costs is going to be, again, that third point that senior companies are going to be looking at. And it's an attempt to reduce the risk and exposure to an uncertain market. And then just one key point with that, remember, it's all relative. Big projects have big costs. So you need to be able to delineate how that big cost and big project against these smaller projects. Putting it all together, gold is trading at an all-time high, and I believe is poised to go much higher. I believe there's a golden opportunity in the junior gold companies. The sector is undervalued. The market is hungry for discoveries, and I believe we're on the cusp of an M&A frenzy like we've never seen before. Thank you very much for having me, and good luck.
Thank you, Brian. That was a great presentation. And now we're going to turn to Pure Gold management. Our host today, we'll start first with Darren Lebrance. Darren is the president. Darren's CEO and director. He's a registered professional geologist with a deep background in the mineral exploration industry. I'm going to focus on the part of the resume that is relevant to very relevant to what's the development of their current property. Darren was the former geologist of Placer Dome's Campbell mine, and the Campbell mine is right next to Pure Gold's Madsen mine, so that's important. And he worked with Placer Dome. Darren also co-founded with Mark O'Day Pure Gold Mining. He's the who's the founder and the director of Oxygen Capital. A pleasure to introduce Mark. We're lucky to have Mark as well with us today. He's chairman, founder of Oxygen. As I said, Mark has seasoned geologist, but also a deal maker in the business. Mark has built, financed international mining companies from Canada to Africa. He recently co-founded and served as executive chairman of True Gold Mining after building the Karma heap leach gold mine in Burkina Faso in West Africa. True Gold was sold to Endeavour Mining in 2016. Mark's also co-founder and CEO of Frontier Gold, which he and his team grew the company from a startup to its sale in 2011, sale to Newmont Mining. The deal included also a spin out of Liberty Gold. So on that note, I'm going to turn the call over. We're going to start with Mark today. Mark or Darren? Mark, yes. Turning over to Mark. Thank you.
Thank you, David. And so Darren and I are going to split this presentation. I'll jump in at the beginning here and provide some sort of high-level thoughts and views and observations on our project, on our jurisdiction, and Darren will finish off with some nuts and bolts on what's happening at site and sort of our timeline to production and first gold pour. So thank you for attending here. I look forward to your questions at the end of the presentation to Darren and I. I think Brian Lenny at the beginning, he sort of nailed the synopsis of making a case for gold and why it's important and how it fits into the financial sort of an economic systems out there. And I agree with his analysis. I also agree with the comments he made about what makes the company relevant today. And really, when you look at the curve, the sort of the Lassonde curve, as they call it, from discovery or inception all the way to production, there are really two sweet spots in that curve. The first sweet spot is discovery. So that's where you take a patch of land and it goes from nothing to being worth something through drilling. That's a really steep part of the curve where stocks go from 10 cents to a couple of dollars. And then they tail off and go through some of the more boring phases like permitting and financing and construction. And you come out the other end to the next sweet spot, the next steep part of the value curve, which is production. And a company that has either of those things, I think, is a great candidate for investment and obviously a great candidate in the M&A space as well. Pure Gold has both sweet spots, and it's unique in that respect because we're right on the cusp of production. Our first 1 million ounces of reserves start pouring in 4 months, so we are the next Canadian, in fact, the next North American mine to come into production. And when we do in 4 months, by Christmas, we'll be the 17th highest grade gold mine in the world. So we've got grade and size and scale there as all of the vital underpinnings of this asset. And we've also got discovery. So this is a project that has so much room to grow, so much opportunity for ongoing transformational discoveries that can propel the valuation higher through the drill bit. So you don't forsake or forego that other sweet spot just because you're in production. And Pure Gold is incredibly unique in that respect. And we're in the type of deposit that is known to have wonderful surprises at depth.
Is it urgent? Okay.
Oh, we've got somebody on the phone there. Okay, I'll carry on. So the four themes.
Sorry about that.
The four themes that we're going to touch on today as it relates to Pure Gold. Their jurisdiction, the importance of jurisdiction. We can't stress that enough. We'll get into that both geologically and sort of geopolitically. We're in Canada, obviously. These maple leaves you see on your screen is no accident. This is true Canadiana. We are in the heart of one of the highest grade gold belts in Canada, if not the world. We're going to talk about the importance of grade and how, I've mentioned it already, how this is up there in the 95th percentile worldwide in terms of grade. We're going to talk about size and scale. It's rare to find a high-grade deposit. It's even more rare to find a big high-grade deposit, and we have one here. This is a 2.5 million ounce deposit at around 9 grams per ton. It's incredibly unique. I mean, in a world where we're inundated with big low-grade deposits, and many of which can work, finding a big high-grade deposit is incredibly exciting, especially located in a jurisdiction like Red Lake, Ontario, just north of your border. And then final theme will be growth. How do we envision, or how do we take this project from an initial phase of 100 to 120,000 ounces of annual production to something closer to 200 plus? And we think there's all kinds of opportunity in the near term to scale this project up, right? So those are the kinds of themes we're going to touch on today, and hopefully they resonate with the audience. Next slide. I will be making forward-looking statements throughout this presentation. Just want to make that known. This is a shot of our mill. So I talked about us being on the cusp of production. Well, you're looking at the nuts and bolts of all of Darren and his team's efforts over the last couple of years. This is our mill that's almost functional. We're putting the final touches on a bunch of componentry that'll be assembled inside the structure that you see right here. But we're almost there, right? You're looking at a project that is very, very near completion. We've got 4 months before we start flipping the switch and pouring gold. So we're all incredibly excited to see that happen. Next slide. We'll talk a little bit about people just to give you some comfort over who we are. You got some biographies at the beginning from David, but really, if you're investing in a company building a mine in Red Lake, you want a team that has operated in Red Lake before, and you want a team that has built and operated mines in the past throughout their history. And so we have deep Red Lake specific experience. Both Darren and I cut our teeth in the early parts of our career working at mines in the Red Lake camp, just up the road from us. So it's incredibly gratifying being back effectively where our careers were born, building our own mine and operating our own mine for the first time in the camp. And so there's a great deal of satisfaction, and life is full of circles coming full circle. And for both of us, this is coming full circle in terms of where our careers really launched. And so we're happy to be here. And there's 4 others on our executive and board who've also spent huge chunks of their professional life in the Red Lake camp. In terms of mine building and mine operating, there's 68 mines. On the next slide, there's 68 mines that our team collectively have been involved in operating around the world. So this is not our first rodeo, so to speak. We've done this repeatedly, and our collective team, board, management, and owners team have got a broad worldwide footprint here. So if you look at these dots in green, there's 64 mines or deposits that we have actually found through drilling and through exploration. So we're great explorers. In orange, there's 33 mines that we've built around the world. And in blue, there's 68 mines, as I've said, that we've operated. So it's an exciting deep pedigree of bench strength there. This slide you see in front of you right now is a shot of a typical highway scene in Red Lake. You're in Red Lake for one reason only, that is to mine gold, right? This is a mining mecca, right? There's been continuous mining of high-grade gold in Red Lake, Canada for a century now. So there's been 30 million ounces of gold taken out of the Red Lake area over the last century. And everywhere you drive, you can effectively look at the skyline and see these head frames, which are sitting above deep shafts. They basically deep elevator shafts that go down as deep as 2.5 kilometers into the earth, and they're mining down at those depths right now, right? And they've been mining some of these individual ore bodies for as long as sort of 80 plus years. And so we are just down this highway. Follow that power line, follow that paved road, and you arrive at the next head frame at the Pure Gold mine site. And so we are literally the next gold mine to enter production in this incredibly storied, legendary camp. And I'll give you a little bit of background on the geology of Red Lake, not a whole lot on the next slide here. I just want to show you where all the big deposits are, right? If you were to if you were given a gift of acquiring land within this belt, within this district, where would you want it? Where would you want to acquire that land? And the answer is one of these 2 red dashed areas. So we've got two areas outlined, one in the north and one in the south, that contain, within those encircled areas, they contain about 95% of all of the gold that's ever been produced in the Red Lake camp, right? So you want to be in one of those two trends, one of those two mining trends. It just so happens that two companies on Earth, on the planet, really that's it, two companies own both of those, or each of those trends. The northern trend is owned by Evolution. They bought it from Newmont, who bought it from Goldcorp. And the southern trend is owned 100% by us. So we have some of the most fertile real estate in the camp. We own it 100%. We've got 2.5 million ounces of high-grade gold already defined that's going to launch us into production as the next sort of multi-generational, multi-decade producer in Red Lake. Here's a slide. It's a cartoon, really, but it depicts, it's a vertical cutaway comparing those two trends. Okay, so the picture on your right, or the cutaway on the right-hand side here, is the Red Lake Mine Complex, owned by Evolution. And you can see how deep they're mining there. They're mining down 2.5 kilometers deep. And there's 4 shafts that take workers and ore up and down. And that has evolved, that footprint has evolved continuously over 85 years. And 25 million ounces have been taken out of that red blob, that red footprint. We think we are at the starting gate of a very, very similar system. On the left-hand side, you see our ore body and our reserves and resources. And unlike Red Lake, unlike the Evolution ground, we're only down 1 kilometer so far. So we are at the very beginning of our mine life here. We have at least another kilometer to go before, in our opinion, before this system even gets close to the depths that they're still mining up the road. And the red outline you see on that left-hand side of the image here represents our reserves and resources, which there's 2.5 million ounces of resources. And within that, we have defined 1 million ounces of initial reserves. Okay, and that's going to get us started for our phase 1 mine plan, which, as I said, will be in production in about 4 months. What's interesting about this picture is that red dot you see that says 14.3 grams over 2 meters. That's a drill hole that pierced the gold system 1 kilometer deeper than our current reserves are sitting. So we have a high degree of confidence that our ore body is going to extend for at least another kilometer at depth. So the growth potential here, as I mentioned at the beginning, growth and scale are an important theme here. Not only is it already a big deposit, we think it's got the potential to get a whole lot bigger because we have pierce points down an extra kilometer showing that this mineral system continues. The next slide. Here's another view of our ore body. I don't want you to get fussed about all the numbers. The numbers are there to really illustrate one thing, and that is grade. How rich is this ore? How high grade is this ore? How much is a ton of rock actually worth, right? And so when you look at these drill intercepts that we've got labeled there, if you start in the 8 zone, you're looking at 4.5 meters of 466 grams per ton. If you're wondering what that is in ounces, basically divide it by 30, right? So 466, it's well over 10 ounces per ton. 5.5 meters of 342. I mean, this is a high grade gold deposit. From tip to tail, through the whole 7-kilometer long trend of mineralization that you see here. And why do we have such confidence in it being a consistently high grade deposit? We have 1.3 million meters of drilling into this ore body. I would wager a guess that no one on the call here today has seen an ore body with 1.3 million meters of drilling defining it. It's incredibly rare to see an ore body with such density of drilling. what that means is we have a great understanding of the geometry of our gold zones, the continuity of mineralization, and how we're going to mine it underground. In fact, in our reserves, in the area that's shaded dark red here, in that area, we've got a drill hole every 6.5 meters. In other words, we have a drill hole every 20 feet. If you compare this to other types of deposits or other gold deposits around the world that maybe you're looking at, or that you've evaluated or invested in your history, in your lives, it's not uncommon to have 50 meters separating or 100 meters separating drill holes. So hundreds of feet between drill holes with grade interpolated between those holes that is effectively speculative, right? But we have eliminated that speculation, and we drill the hole every 20 feet. So we know exactly the distribution of gold here. So in terms of managing risk, we have managed that risk incredibly well by understanding the distribution of high-grade gold here. On the next slide, here's another way of looking at our ore body. This is a vertical slice through the earth, and it stretches for about 10 kilometers along the long axis of our ore body. And really what we're looking at here is a whole bunch of magenta dots. And each one of those dots is an individual assay or gold value from an individual drill hole. Okay, that's greater than 10 grams per ton, or about 1/3 of an ounce per ton. And on this image, we have over 13,000 magenta dots greater than 10 grams per ton. We have so many dots that it almost looks like a shaded in polygon colored in magenta, right? That's our ore body. I mean, this is our ore body defined by over 1 million meters of drilling, thousands and thousands of high-grade hits, showing an incredibly coherent picture of continuity and geometry. So you can tell where these ore bodies are plunging. Where do you go chase them, right? On the next slide, this is how we think these ore bodies are plunging, and where they're going to extend with ongoing drilling. Because what's really, I think, fascinating about this picture is all of the white space. There's so much white space around all of these magenta dots, and that white space is white because we haven't drilled it yet, right? And it's wide open for growth and expansion. And we have deep drill holes, like the one labeled 14.3 over 2 meters. There it is right there. That's down 2 kilometers deep. All right, so this is an ore body. This is a mine that's going to start from surface, and over time, we're going to wind our way down and mine our way down deeper and deeper, keep drilling deeper and deeper until all of this white space starts expanding and stretching down deeper into the earth, just like the other picture I showed you from the other mine in the region. And so it's that kind of growth, it's that kind of exciting organic expansion that has brought in a lot of our key investors. So Anglo Gold Ashanti, for example, is the world's 3rd largest gold miner. They own 15% of this company today. They love what we're doing. Newmont, who's the world's largest gold mining company, they own about 5% of the company. You've got people like Eric Sprott, who has made an absolute fortune recently through his role and investment in Kirkland Lake Mining. He used to be the chairman of Kirkland Lake. You all know that, I'm sure. And he has redeployed capital, a lot of capital, into a whole series of names. What he likes about this is that it reminds him a lot of the early days of Kirkland Lake, where projects like Fosterville and Macassa got transformed and expanded incredibly aggressively through ongoing growth. Rob McEwen owns about 5% of this. He was the founder and original chief executive of Goldcorp. And they had the Goldcorp Red Lake mine just up the road from us that, again, went through a similar exponential growth phase when they found a super high grade zone in the late 1990s, and they went from 50,000 ounces a year to 500,000 ounces a year, almost overnight. So you've got these four key fundamental shareholders who backstopped and have been cornerstone investors for years. They own about 35% of the story, and for exactly the reasons I just laid out to you. So as we approach the cusp of production over the next couple of months, we're continuing to drill, we're continuing to be aggressively growing this deposit, growing our reserve base, growing our resource base. We've got a 30,000 meter drill program that's underway. Eric Sprott has funded that exclusively. He put in $15 million a few months ago exclusively to go see us expand our drilling program and keep that growth engine going. So that's the section of the presentation I really want to leave you with, those four themes. And now let's get down into some nuts and bolts in terms of what's going on the ground and what this project generates in terms of cash flow in this expanded margin world that we're living in right now, with gold at around $1,900 or $2,000 an ounce US. Over to Darren.
Yeah, so I'll speak to the numbers in a minute. I just want to give you a sense of what's happening on the site today, and I have been on site over the course of the last 2 weeks, and I can tell you there's a real excitement that's building there. You know, one of the ways you measure the the success of a project is you look at the team and you see the level of commitment and enthusiasm that they show towards a project, and that's clearly evident from the moment you walk through the gates at our Pure Gold mine. You know, we put together a phenomenal team on site there. We've the operational team in place, miners from the face all the way through the support services, and universally everyone's truly excited about what we're building here. It's a thrill to be back in Red Lake and to be managing such an exciting operation. You move underground. We've been underground for the course of the last 2 years. It started with our test mining, where we went in and we mined out portions of 2 stopes, reconciled beautifully to our geologic model and to our resource model, giving us a lot of confidence in the data that's informed our resource and our reserve estimate. In fact, you know, we achieved a little bit better in grade, about 15% in that test mining, and ultimately we made a discovery in the course of mining as well that forms part of our reserves now. We've continued that work over the last year, really driving our development, opening up the deposit, gaining access to the first ore that'll come to our mill. And to date, we've got about 7,500 tons that's been mined, it's stockpiled, it's ready to go, and it's running our average reserve grade. We started to access the ore body on multiple levels, and you know, I was in one of the faces last week where we crossed one of the sills from a long hole stope, and it's a beautiful thing. It's exactly where we expect it to be. It's highly visual, and it's showing grades like we expect to see. So that work is going phenomenally well. We're actually doing about 50% better than the plan we had in our feasibility study. And what I mean by that is we're mining faster with the same amount of equipment and labor. So, you know, at the end of the day, that translates into lower costs on a per unit basis, and more importantly, it opens up the deposit faster. It means we can access higher grade quicker and ultimately get to our high grade 8 zone earlier in the mine life, and gives us an opportunity to really grow that. So that's progressing extremely well. By the time we turn the mill on in 4 months' time, we should have about 25,000 tons of material stockpiled. So that's a fantastic start to making sure the mill is well fed right from the day we switch it on. On surface, it's an absolute beehive of activity. Mark showed you earlier the milling facility, and we've gone through and significantly rebuilt that mill. The grinding circuit is new. The gravity circuit is going in right now. This is going to be part of the milling process that extracts free gold and really recovers that gold with a very low cost. We've got all the new piping is being put in, the pumps are being put in, our backfill plant to supply tails to the underground for fill is effectively complete, and we're making basically redoing the gold room, and that's largely underway and nearing completion as well. So the mill works are coming on fantastic. All the other surface infrastructure is largely in place, and so again, we're very much on track for for turning the mill on, and commissioning activities will start in November and first ore to the mill in December with first pour before Christmas. So looking at the numbers, this is from our phase 1 mine. So bear in mind, this is from the reserves, 1 million ounces at 9 grams per ton. It doesn't, it doesn't take into account the broader 2.5 million ounce resource. So the first phase of our scalable asset here shows about $2.5 billion in revenue, $1.3 billion in free cash flow. And really that's driven by grade. Again, at 9 grams per ton, really to put that into context, we're in the 95th percentile worldwide by grade. And so that high grade drives a very low unit cost. You can see it here, $787 an ounce, all in sustaining costs, which means in today's market, we're seeing incredible margins, about $1,100 an ounce on a per ounce basis, or in Canadian terms, $14.50 an ounce. And that drives all kinds of cash flow to continue to work on phase 2 and really drive that organic growth. So we're, as you can sense by my enthusiasm, we're really excited about where we're at today. We're just, a few weeks away really from production when you think about it in the bigger picture, and it's just a fraction of what we've defined and discovered to date. And we're already thinking about phase 2 and what it's going to look like, and what that'll do for the production profile and ultimate economics of the project. So we do think we're just getting started. And Mark ran through the list of investors. Clearly, these 4 share our vision, owning 35% of Pure Gold. Well, as you might expect, we're also thinking about opportunities and initiatives as we start up, the mining operation here. And clearly, the exploration side has well-established potential. Not only are we looking at expanding those phase 2 resources, those near-surface discoveries, but we're looking at conversion of inferred resources within the phase 1 footprint. There's 250,000 ounces there that really is just lacking for drilling, and we think there's a real strong opportunity there and likelihood of those converting across into reserves. We've got expansion of the ore body near our existing development. I talked about the test mining and how we made discovery in the active test mining. More recently, we put out some underground drill results. So you can see one of those holes shown there, 46.7 grams per ton gold over 7 meters. This sits directly in the hanging wall of one of our stopes from the reserve plan. We've subsequently intersected it with multiple drill holes, and it's developing into a hanging wall chute that will form part of our mine plan. And so those kind of incremental discoveries, I think that we'll continue to make those month after month as we move through the mining operation. At the end of the day, I'm convinced we're gonna outline more ounces within that footprint than we have in our reserves today. Obviously, the 8 zone is a huge opportunity for us. It is our high-grade zone. There's 2 ways to increase the production profile. One is to expand the plant, which we intend to do with the incorporation of our phase 2 resources, and the other way really is to grow those high-grade ounces. The 8 zone runs 3 to 4 times higher grade than our average reserve, and it drives incredible value. So I'm truly excited for a year out from now when we're underground. We've set up for underground, and we're starting to drill off inferred within the 8 zone, and we're stepping out on it, expanding it both up and down plunge. More broadly across that, we also have a large land package. We've got multiple drill-ready targets that we're advancing in the background, some of which will be tested with our own ongoing drill program. On the mining side, we've got all kinds of opportunities in front of us here. Feasibility study was done at $1,275 an ounce. Clearly, we're well above that today. And importantly, when you think about it, particularly from an underground mining perspective, we make decisions on what's mineable and what's reserves based on the price of gold and a cutoff. It's a very surgical approach. Obviously, at $1,900 US an ounce, our cutoff grade would be much lower than the 4.75 that's broadly used through our mining footprint. And so what that means is, we have some potential here with more work to outline a larger reserve based on the movement of the price of gold. Now, clearly, we don't want to displace high-grade ore within the plant, but this is important in the context of stockpiling. We're already retaining material that's 1 to 4 grams per ton. We're keeping it on surface to be mined or processed at a later date. And it's also very important in the context of that expansion that we've been talking about. Clearly, as we expand the mill, we can incorporate differences in cutoff grade, allows you to mine larger shapes, drive more tons, and really drive that expansion of production. We talked about throughput there, mine development, again, productivity we're seeing on underground, I really think will translate into improvements on the production profile, optimization on high grade, and driving towards that 8 zone. One of the other things that we're about to start here is a second portal and ramp. The initial ramp is sufficient for an 800 ton per day mining scenario. With the incorporation of a second ramp, what it means is we're opening up the north part of the deposit quicker. It allows us to remove a bottleneck on that primary ramp. If you imagine 800 tons per day coming out of one ramp, well, imagine what you can do with two. And so we think that that's really going to drive productivity again towards a expanded case. So it's something that's being colored and initiated as we speak. So things are progressing extremely well on the ground. Phase 1 is nearing completion. We'll start pouring our first 1 million ounces here in December timeframe. We're already thinking about the second phase. We've got resources in place. We've done early stage engineering. We're drilling to grow those resources, and we're targeting bringing them online in the early part of the phase 1 mine life. And so, we think that we're just getting started here, and the excitement's only beginning. So I think with that, we'll open it up for questions.
Very well presented, gentlemen. We'll start. We're going to start off with Chesley Morton. Chesley, questions today? You just have to unmute, Chesley. We can always come back to you.
There we
Yeah.
go. Sorry for that, David. Thank you, gentlemen. That was just another exciting presentation. It's really fun to see this thing coming to the point where we're about to see you guys in production. You touched on it, the lower cutoff grade that you probably have now because of the higher metal price. Does that result in a significant change in your mine plan? In the sense that maybe even though your production is more efficient than initially gauged, that you might still be in that lower grade for a little longer period of time before you hit the high grade?
Yeah, thanks. No, I don't think you can think of it that way, really. It provides opportunities. And so when you look at the cutoff grade, again, we're not gonna lower the cutoff grade to mine lower grade stopes, but it does provide an opportunity to build up an inventory, if you will, of material. And taken in conjunction with some of the thoughts that we're having about expanded production, I talked about a second ramp. We've recently done an evaluation where we're expanding the size of the ramp as well. We'll be incorporating larger trucks underground, and these are all incremental changes to the feasibility plan that at the end of the day have through sound work have really shown an opportunity to drive value. And so we think that there's real opportunities to increase the resource base, increase the reserve base, obviously with the lower cutoff, and ultimately incorporate that in future milling or in an expanded production profile. But we are not going to displace high grade to mine lower grade longer.
Gotcha. Do you presently have additional permitting in process for the higher production rates you anticipate down the road?
Yeah, so we've got permits in place right now for 1,089 tons per day, and so that's slightly larger than the plant that we're building today. Longer term, we would look to update those permits through an amendment on those permits, and there would be work to be done there. But importantly, we're not looking at a change in footprint. And so some of the key drivers from permitting are expanded tailings management facilities and so forth, or changing the footprint, or in a pit mining operation, changes in that kind of footprint. We're not looking at that, so it should be a more straightforward regulatory process on that basis. Okay,
and then one final one. I don't want to be hogging this, but at some point, if some of the other callers on the or participants on the call have the same feeling I do, we're going to have higher gold prices at some point. Would you be tempted to lock that in at some point with hedging?
Yeah, I mean, it's always a temptation, and I guess you got to look at the context of where you're at and where things are moving. We have certainly discussed it, but there's no I don't think there's any appetite right now for hedging with respect to our production profile.
Gotcha. Okay, thank you.
Thanks for your questions, Chesley. We're going to turn right to Doug Loud. Doug, questions today?
Now that I've got myself unmuted, hi guys, great story as always. Probably a typically dumb lawyer type question, but in all of your pictures, your findings are going deeper and deeper, but they start at the surface. So why aren't you doing some open pit other than the fact that the permitting people would freak out?
Yeah, I think there's a couple of ways of looking at that. Clearly we are permitted as an underground mining operation today, and so it would take additional permitting to look at open pit mining. The other thing is, when you look at these types of deposits, the economics are really driven by mining ounces and not tons. And so we are trying to maximize the grade. We're trying to maximize the ounces that go through the mill and minimize the waste you're moving. In an open pit environment, ultimately what you're driven by is two things. One is the grade of the mineralization itself, and two is the distribution or the lateral extent of it. Obviously, as you mine deeper and deeper, you got to push your walls further and further away from the deposit itself. And so in this type of deposit, you end up with what we call a high strip ratio. And what that means, you're mining a lot more waste to get a ton of ore. And so, yes, absolutely, our new discoveries to fork the wedge to Rust South, they would optimize pits. They'd be highly economic. It'd be a lower cost of mining, but you could only go so deep before you're presented with too much waste movement on the walls to make it economic. So it's far more economic to get down underground, to follow it, kind of lift by lift or sill by sill in a long hole basis, and it drives better economics in that fashion ultimately.
I have to say I'm fascinated by the white space between the wedge and the rest of the project, and my optimistic side believes there's a lot of red in there. You just haven't found it yet. So
Absolutely.
Thanks.
Yeah, it's phenomenal when you look at it. 7 kilometers, 10 if you look at the north part of that long section, and the amount of white space in there is incredible. I think a real testament to the opportunity is the fact that Fork, Wedge, Russet South, these are surface discoveries that we made over the last several years in a camp that's been mining for 100 years. It's got all kinds of opportunity here to expand.
Really fascinating. Great. Thank you very much.
Thank you.
Thank you, Doug. We're going to turn to Howie Flinker. Howie, do you have a question today?
Let me unmute. There. Hey guys, this is probably an early question, but I have 2 questions. But have you seen any inflation in caterpillars or Hitachis or cement or other stuff, or is it still early because the rest of the mining business stinks?
Yeah, I think right now with kind of the worldwide economic developments, the inflation that we're seeing on site here with respect to our costs is negligible. In fact, when you look at the underground mobile equipment that we've purchased to date, it's all been at significantly lower costs than the feasibility study. Fuel costs are much lower than they were when we conducted our feasibility study. Labor rates are pretty much on par with our expectations. So we're not seeing any kind of inflationary pressure on costs today, which makes the the increase in gold price and the margin that much more appealing.
Certainly. And second, different question is, what's Maurice Belanger doing? I met her once when she was at the Atlantic company. She seems to know what she's doing.
Yeah, we're thrilled to have Maurice join the board. Maurice has come across from a very successful build and commissioning and production operation at Atlantic Gold. Previously, she was VP Technical Services for Goldcorp in the Red Lake camp. She brings a real wealth of experience to the board, and forms part of our technical committee for steering the project towards completion. So we're absolutely thrilled to have her on board with us.
Does she have a full-time job?
I'd also throw in I'm not sure if you're aware of this, Howie, or not, but Maurice was on my board at True Gold. So I gave her first board seat actually back in 2015, 2016, as we were completing the Karma mine in Burkina Faso. So she was on our board there, did a great job for us, and we're delighted to have her back.
Oh, I did not know. Thanks.
Thank you, Howie. We're going to turn to Jim Vale. Jim, question today.
Hi, guys. As usual, continued a great story. But in the last 48 hours, Battle North, Pure Gold, and Evolution have talked about the fire in Red Lake, but you guys didn't say anything about it.
Yeah, we were the first company to press release about the fire. So we were absolutely out in front of this thing from a governance and a communication point of view, Jim. So it was inevitably going to come up on the call. We took precautionary measures and have reduced the workforce at the mine and moved people out of the camp. And unfortunately, this is Canada. This is forest fire season, and you know, the fire's under control and sort of moving away from our site. But we were right out in front of this in terms of public disclosure. We were the very first press release. And in fact, it took, I'm going to say 24 hours before any other company put any news out on it.
That's right. Now, how is it going to affect your schedule for production in the first pour? Then you
Yeah,
gotta-
I'll touch on that. I mean, obviously, it's you know, it's an evolving situation. Right now, the fire is active. As Mark said, it's been moving away from our site and hasn't impacted any of our you know, our infrastructure or equipment. At the end of the day, we'll see when it gets put out. I'm really encouraged right now, and the winds are still. There is 4 days of rain forecast here starting tomorrow, and so I think that we can put a pretty real dent in the fire and get back to business. You know, assuming we're back to work, you know, in the coming days, really we'll be able to make up that time. The work that's occurring on site will be scheduled in. It's not impacting the delivery of equipment to site. We've got a staging area set up for that. It's not impacting any of the expediting work that we're doing today. And so, you know, at this point, I don't see any impact on our schedule, but obviously we'll have to watch the fire as it evolves.
Great, thank you.
Mm-hmm.
Great question, Jim. We're going to turn to Lawrence Sharp. Lawrence, all you have to do is unmute and you'll be on. There you are, I think. Okay, we'll come back to you and we're going to turn to Murray Vanderbilt. Murray.
Happening here. Let's see. There we go. Whoops.
Gotcha, Murray.
Do you hear me all right?
Yep.
Yeah.
Oh, great. Could you run to slide 10 for me? So what I'd like you just to spend a minute on, I'm looking at your mineral resource and reserves that were published in your previous presentation, and looks like your 4301 was February 19, 2019. And when I look at this, you know, you'd mentioned that the red area is in your reserves and the magenta hasn't yet. Does that mean that those results have not yet been put into your reserve and resource calculations? Or what?
Exactly. And so you've clued right into the opportunity here. So our phase one mine, which, you know, reflects the numbers that Darren just took you through, is only the dark red portion of this slide. So the magenta and the orange, everything else is gold that we know exists in categories that are considered resource, not reserve today. And the sum total is effectively about 1.5 million ounces of additional gold that we know of today. It's drilled off, we know it's there, we know it exists, that can get converted to reserves over a very short period of time with not a lot of capital. It's what we're doing right now, and incorporated into an expanded mine plan and brought into phase two of our mine plan, where we can go from 800 tons a day to 1,600 tons a day. And that material comes from the lighter pink and the like the wedge, the fork, the rusted south, and zones like that.
On 10, I don't. Yeah. On 10, I don't see the dates for all those holes drilled after February 19.
No, that's not the case. Effectively, when you look at the resource estimate itself, pretty much everything that's been drilled within the last 2 years was not incorporated. So the drilling that we've conducted over the last 2 years would not be incorporated in the resources and reserves. So there's certainly an opportunity there to look towards a future update.
So then, in conclusion, we can say absolutely there's more there than's been reported through the 43-1. It's just a question of how much, and we won't know until it's drilled out and it's drilled deeper.
Yeah, absolutely, 100%.
Yeah. Great, thanks. Nice presentation.
Thank you.
Thank you.
Thanks for your participation, Murray. We're going to turn to Michael Potter. Michael.
Hi, thanks for a great talk.
You with us, Michael? You're breaking up, Michael.
Much year from here on, and sort of what sort of percentage of that will be from surface, and what?
Michael, you're breaking up.
Hello?
Yeah, we're going to come back to you, but you are
You're
breaking.
frozen. My computer's frozen up on me. You've probably got to come back to me.
Okay, okay, great. Thanks, Michael. We'll
Yeah,
go to
I've got a.
You can also text your question in, Michael. We'll turn to Rick Winters. Rick.
Yeah, thank you. Good presentation. A couple of things. First, I certainly appreciate the density of sampling there. I'd be curious, what is your cutting protocol in general? Is there something you do beyond just statistics, just in that sort of high grade environment? And just as a follow on, I would be curious, given your information in your model, and now that you're well advanced with your development and you have development muck in front of the mill being built, what does the reconciliation look like to date from drill hole to channel sample to muck sample? Do you have a view on that yet, and what that might mean for really getting to a tight reconciliation once you start production?
Yeah, I'll start with the cutting strategy or limits first. It really is an art. It's primarily based on the statistics of the deposit and kind of the gut feel of what's represented. Obviously, when you cut something, you're really looking to limit the influence of very high grade assays on the broader resource. My experience in the Red Lake camp, and certainly driven from Campbell and more broadly from the high grade zone, is that those cutting limits can be quite conservative. In a high grade asset, with the closer space data you get, often trend towards the higher grade. And what they found with the high grade zone was, in fact, that the cutting limits that were used there, grossly underestimated the amount of gold that was in the high grade zone. We certainly saw that in some of the high grade zones in the Campbell mine as well. With respect to our own resource estimate, the way it was done was there are multiple domains or zones within that estimate that were each looked at individually. We looked at the distribution and grade within those domains, and then we made an estimate as to what was an outlier and cut things back down to the level that seemed appropriate geostatistically for that domain. At the end of the day, the only way you'll know if that's appropriate or not is through the active mining, as you said, in reconciliation. It is early days on that front. The work that we've done thus far, we've seen, as I said earlier, we've seen a very good reconciliation on tons from the actual mining to the drill indicated resource and reserves. Grade wise, we saw 15% higher grade in the test mining area, and so that's really the basis of the information I have here right now. So I expect that that's going to be the case moving forward. I mean, we typically see things improve in grade with closer space data, but it's really early days, and we need to build up a bigger data set to really look at those cutting limits and see if they're appropriate at the end of the day.
Sure.
I mean,
I guess. Go ahead.
If I can add one point there, Darren, that I think is relevant to reconciliation, is that parallel to our ore body here, in a parallel zone, there were 2.5 million ounces of gold mined out over 37 consecutive years at around 9 grams per ton. So we've got a 2.5 million ounce bulk sample to reconcile what the grade with our ore body. I mean, this is all part of the same system, and our ore body reconciles incredibly well in terms of consistency of grade on an average basis with an ore body right next to this that had been mined out and stopped producing in 1976.
Sure. No, I appreciate that. I guess I have some experience there, and it was quite a challenge up front to be able to reconcile what you're mining to what was in your model. But it comes with time. But certainly appreciate the information that you guys have put together, and that you're you're kind of 15% is pretty good right now, quite frankly. And for me, it goes to how quickly do you get into, you know, what your budget is. A second question I'd have is I'm just a little curious. I guess that I've missed it a bit, but give me a general idea in terms of timing on phase 2, because you know you talked about being able to access ore from the north and the ramp, and certainly it seems like you can get to ore delivery pretty quickly. The rest of it, what is it? 18 months? Is it 12 months? Is it 24 months? Kind of what's the general idea there in terms of overall timing for that?
You go ahead, Darren.
Yeah, so there's, you know, I think the first thing to kind of highlight here is that for phase 2, when you look at Fork, Wedge, and Russet South, it's not that we have to go out and find these ounces. They're already there. We've already drilled them. We've already got a resource statement in those areas. We have done early engineering. We put out a PEA, you know, early last year that looked at them and looked at how they'd be mined, what kind of productivity we could get out of those zones, what the capital would be. We've outlined a 800 ton per day mining scenario out of those zones, and so what we're doing now is looking to determine what the actual true size of these resources are. We're looking to grow them. We're looking to convert inferred into indicated resources, and ultimately we'll revisit the engineering work and look to incorporate them. So, kinds of the sequence of events here. We've got drilling occurring over the next 18 months. You'll see an update to the resource. You look to update your engineering work, and then at the end of the day, right size the mill for the appropriate resources and reserves, and then move forward on the capital side to incorporate them. So drilling over the next 18 months, engineering work will happen concurrently to that, and ultimately you're looking at bringing on phase 2 in about year 3 of operations.
Okay. No, I appreciate that. And one of the things that I really like about what you've been able to do is your financing is really good, and it's really good in the sense that you've got to start paying interest in March, but you don't have any principal repayments outside kind of the streaming arrangements at all well into 2022, which means if we have a good startup, you'll have plenty of capital to really advance things pretty quickly. So I appreciate that. Thank you very much.
Thank you. It's an extremely flexible package.
We're going to turn to back to Michael Potter. See if his communication is improved. Michael?
Yep, I hope you can hear me now. My internet went.
Yes, Michael. Yep.
Yeah, you've got a lot of drilling done so far. How much drilling do you reckon you're going to have to continue doing each year to keep up with proving up your resources and carrying out your general exploration, both laterally and to depth? And how much of that will be from surface and how much will be from underground?
Yeah, it's a good question. I mean, we've got a 30,000 meter program laid out here between now and early next year. That's all pretty much surface work. That program will be expanded next year and carry out through the balance of next year. And that really is to, achieve the, as we said, the definition of phase 2 and some early stage exploration work on some other target areas there, including the 8 zone and 8 zone gap. Underground, when you look at the underground drilling program within our feasibility plan, kind of that broader budget, we laid out a drill program that pretty much is a life of mine operation. And so you're going to see drilling as a part of operating over the course of the phase 1 and phase 2 mine. And it'll have the same kind of goals and objectives. 1, to convert resources and reserves in the footprint of a rather near existing development, and 2, really to step out and expand the ore body. Some of the more expansionary drilling from underground, we're doing drilling now that's close proximity to development, but when we really start looking to step out on the 8 zone and deeper parts of the deposit, that'll start not too far in the distant future here with the establishment of exploration drifts underground. So it's certainly something we're very committed to, both on the surface and underground front, and it's been incorporated into the feasibility plan that we laid out.
Thanks a lot. I think you're going to keep yourself very busy. Thanks.
Absolutely.
Thanks, Michael, for your questions as always. Scott, before we proceed to close, do you have any questions from the audience?
Well, yes, I did want to mention that we have probably more than 20 some questions from the audience. Just great participation from the audience. The stories very exciting. I don't know that we'll be able to get to all of them live, but what we will do is get them over to you guys and get answers back to everybody. So we want to thank everyone for their participation. A lot of the questions have been answered. Some of them were about the fires, which you addressed, but there was one kind of additional question that came in about that, and it is, does the mine have reserve power in case of forest fires impacting power to the area?
Yeah, so I can answer that. We do obviously have backup generators in place right now for essential services, you know, and as part of our construction plan, there'll be backup generators for life of mine. You know, clearly for a full-blown operation, we would need power to site and we need grid power to site. At this point, the main transmission line into Red Lake is not impacted, and it looks that the fire has turned away from that front. So we're certainly hopeful that it will continue to do so.
Great, thank you. A couple of questions came in about, let's see, Pacton Gold, and I guess they can be summed up by this one. Can you tell us more about the recent announcement by Pacton Gold with Pure Gold assisting with a test survey on their property, and how will Pure Gold Mining profit from it?
Yeah, so that's really our survey. So what we're looking at here is a seismic survey, really looking to look at the structural properties of the rock deeper down in the deposit. So try and understand that geometry. It's done with a long line seismic that starts on Pacton's property and runs across our ground. And you need that kind of spacing just to get the depth profile. So it really is about looking deeper down on our own property.
Okay, great. Next one would be, your study was done with $1,275 per ounce gold at what cutoff grade? And do you have any information on higher gold price and what cutoff grades, ? Would mean?
Yeah, we talked a little bit about cutoff through the presentation. $1,275 US an ounce, translated into largely for most of the phase 1 mine a 4.75 gram per ton gold cutoff. That takes into account the cost of mining, the sustaining capital and a profit margin in there. And so, you know, clearly when you've got a gold price that's many hundreds of dollars above that $1,275, what it means is that lower grade rock is just as economic. And so ultimately at the end of the day, you know, it's an iterative study to determine what the right cutoff will be. But, you know, it presents a real opportunity for growing your reserves, for growing the size of your mining areas, for growing the productivity of the mine, and ultimately for expanding your production profile.
Great answer.
Yeah.
Do we stop with that? I think that's a great way to, do you have any other questions?
Yeah, no, we can stop there, and we will get the rest of them over to you guys, and you can get some answers, and we'll make sure everybody gets their questions answered. So we'll wrap it up from here.
And yeah, it's been a great call, and the audience stayed on, so we really appreciate that. I'm going to pass it to back to Darren and Mark for closing remarks.
Yeah, go ahead, Mark.
Okay. Well, you know, I just want to bring it back to the themes and that we touched on throughout the presentation, and you know, those are the underpinnings of the story. Deposits like this are scarce. When you look at what's out there in your universe of near-term producers, if it's anything like my universe of near-term producers, this is it, right? There is no other mine coming on stream in North America that I know of within the next 2 years, right? So, you know, time is our friend here, and we're delivering this project at the perfect time in the cycle, right? We've got one of the highest grade gold mines in the world, delivering gold into one of the highest gold price environments that we've ever seen, with really no competition behind us. So we're in an incredibly unique position. So, you know, it's probably a good place to end it.
Thank you, Mark. Thank you, Darren. Great presentation. I want to thank everyone for your attendance today. We'll be following up with you, answers to questions and also feedback. Wishing everyone a very pleasant evening, and thanks again for your attention.
Thank you, everyone.
Thank you.